Welcome to G3 Investors. This is Greg Gallagher, and it's Saturday morning, May 23rd, and we're going to talk about gold and silver. Now, this is a 30-year chart of the gold to silver ratio. So it's how many it just maps how many ounces of silver you have to buy at any given time to equal 1 ounce of gold. And it's kind of hard to see this, but about somewhere between 60 to 70 is when it's normal, or 50 to 70. So I'm going to pick 65 as, when I say they're equalized, and that's more or less normal. And the reason I'm picking that is this is a 10-year weekly comparison of silver using the ETF SLV, which it tries to capture the silver spot price by buying silver bullion in the ETF and holding it. Whenever they're equal, that ratio is about 6.5. Okay, so it takes the price of SLV to the price of gold. You have to multiply SLV by 6.5 times. The reason I get to the 65 is because while this blue line represents SLV and it tries to match the spot price, the red line, which is GLD, does the same thing, but you have to multiply it by 10, a factor of 10, to get to the spot price of silver. Now, neither one of them is perfect. Okay, right now, this on Friday's close, SLV was at 1604 and GLD was 163.21. So if you multiply that 163.21 times 10, you get $1,632. Well, the spot price of gold was over $1,700, so it doesn't quite match it. The same with silver. The spot price at silver was $1,745. Okay, and this is at 1604. So it's not a perfect match, but hey, this is the ETF we have to trade. So if we want to trade and we think there's some disparity, as I do, between the price of silver now and the price of gold, and I think both of them are going to go much higher, especially if we have we keep printing money all over the world, and I'll get to that in a minute. But what I want to point out here is the ratio of the gold to the silver is 10.175 versus 6.5. So that means silver must go to 2511 to get to a 6.5 to 1 ratio for these two. And that just so happens to be $25 is about what you would have to pay for a 1 ounce silver eagle silver coin. Okay, and I think I don't know what the price of gold coins are, but they're probably $1,900 or something like that. So the price of the metals are going to be higher than the spot prices because you have the costs of manufacturing and storing and shining it up and minting it and all that. But these spot prices are usually much closer than they are right now. So that's another indication to me that gold, when gold is drying up, that means somebody big is buying it. It's not just mom and pop, and mom and pop are probably buying it too, and they should be. You should be stacking silver or gold or both as a percentage of your assets that you're invested. But I'm not a gold bug, I'm not a silver bug, I'm just a trader. But right now it tells me that somebody, I don't know if it's a hedge fund, I know JP Morgan has about 9 million ounces of silver, so I know they're a big buyer. They disclose that in their 13F filing or whatever. But it could be interesting. Well, warnings are everywhere. When you have the Fed writing a paper about money printing all over the world, something's wrong. And Nobel laureate Robert Shiller, he sees bubbles everywhere. And the bubble is everywhere. It's not just in the stock market. It is in the bond market. It's everywhere but gold and silver, okay, and precious metals. And of course, platinum. There's other, metals that aren't in bubble territory either. But everything else is pretty much in a bubble. Real estate's in a bubble. I don't think it's as bad as the bubble we had earlier, but I think there's going to be a lot of people moving out of these large cities. This coronavirus has thrown this country and the whole world for a loop, and it isn't going to end very good. Let me tell you that. Derivatives. Don't pretend to understand derivatives, but I know the 9 largest banks have 230 trillion, which is 3 times the global economy, okay, of the world. So if that goes south, who is going to come to the rescue of the 9 largest banks? Global debt, 253 trillion, another record. That's 322% of global GDP. And even the World Bank is smart enough to understand that debt waves tend to have unhappy endings. And they usually end up in wars. The Weimar Republic, that was before Hitler came to prominence. And what happened? Well, we had World War II. U.S. corporate debt, $10 trillion. That's another concern, no doubt about that. And then private debt is $1.2 trillion, 50% of which is collateralized loan obligations. So I bet those get paid back. Okay, how big is the silver and gold markets? They're tiny. Here's the silver is 20. The silver stock from the MCAP, all of them combined with where you have the 0.99 troy ounce fine silver, refined silver, totals 23 billion. Apple has 200 billion in cash, so Apple could buy all of it. They probably have to use all their 200 billion because the price would go up dramatically if they started buying big chunks of it. How do I know that? Well, that's what Warren Buffett did. He did that back in 1997 to 1998. The price of silver went up 84%, all due to Warren Buffett affecting the price of oil. One guy, and he's got the money to buy it too because he's got 140 billion in cash. Who knows who's going to start buying it? But I think somebody is. What happens when gold rises? Silver rises more. So here in 1976 to 1980, it went up 717%. Gold, silver went up 1,000. 85 to 87, and so on and so forth. And we saw these two periods here. Now, 2001 to 2008 wasn't that big of a deal, but 2008 to 2011 was a very big deal. But they ran up in both periods. And again, silver almost always goes higher than gold because the ratio, that the average of 65 that I just picked out of the air, it could be 50, it could be 70. Well, I can tell you in 1970, it took 8 ounces of silver to equal 1 ounce of gold. In 1980, that's not too far. That's only 40 years ago. It was 55 to 1. So, but in May, it was 115 to 1. And in March this year, May of this year, it's 115. Now it's down to 100. In March, just in March, it was 120. So it's already started to move big time. And that's what happens. And I think that's what's going to happen. Now, this is something totally different, but I just wanted to bring this up. I've warned my patrons and subscribers that we are in a very narrow market, and they're the most dangerous markets of all. And I just have to show you this heat map that I looked at on Friday. This is the S&P 500, the 500 largest companies in the U.S. stock market, and this is the year-to-date performance of them. Green is good, and you can see the green. There's only about 15 stocks that are really in green, and I'm talking about this big green here, like 53%, 31%, 16%, 860. I'm not that excited about that. There's PayPal at 29%. Okay, so 30%. Okay, so those are the companies. Those 15 stocks just represent 3% of the S&P 500, and they're driving the market higher. Okay, this 30% recovery that we've had once we had the initial drop from the coronavirus shock is a very narrow recovery. That's a very dangerous recovery. Okay, so I could do a little bit of advertising here. G3's trading results. We started Model 2 January 2nd this year, and through May 22nd, we have gained 42.9% by trading ETFs. We're handily beating the S&P and the NASDAQ, although the NASDAQ has beat me so far this month. Haven't had the best trading month. But when the market starts to go sideways, it gets tough to trade. If you become a G3 patron, you can get early access to videos like these. The setups that I see daily, I comment and update them on my comments on the Patreon account each day. You can see those throughout the day, and then we have weekly Zoom Q&A sessions, except for this weekend. Because of the long weekend, we didn't do one. Copy this link into your browser and sign up. $5 gets you the weekly Tier 1 updates, and then $20 gets you everything else, which is all this that you see up here. This is Greg Gallagher with G3 Investors saying good luck, good trading, and have a great weekend.